Hello everybody and welcome to AUD689 Got Talent. For our show today, we will be showing all of you a variety of talents together with the topic group audit. So, here we go, enjoy. The first talent for today is by Mia on planning and administration for group audit. Some companies in the business world have subsidiary companies. Therefore, the holding company is required to prepare consolidated accounts for the group account. This is where the auditor comes in. The auditor for the holding company is required to provide an audit opinion on the group financial statements, whether it presents a true and fair view to the members of the holding company. To make it easier, group audit is only applied when multiple accounting firms are involved in the audit. Before we proceed to the next contents, let's look into a few terms to make this topic easier to understand. Group financial statements include the financial information of more than one component. Component refers to subsidiaries, associates, joint ventures, or even branches. Components can be audited by different auditors known as the component auditor. Group audit refers to the audit of a group of financial statements as a whole. In the first stage, there will be planning and risk assessment of the group audit. This is where the group auditor must possess good understanding of the group's structure in order to have a clear plan of the audit. This includes the 1. Evaluation of the competency of the component auditor and the independence of the standards that they apply. 2. Determining the coverage of work area of the components and the work that they should be performing. 3. Determining the materiality for the group as a whole and also for the individual components. 4. The involvement of group auditor in the work of component auditor. In the second stage, before planning the consolidation process, the audit procedures must be planned by the group audit. There is also a need of good communication from the group audit and component auditor, as it is vital in order to gather sufficient evidences. And lastly, in stage 3, after all sufficient evidences are gathered, the group audit is responsible to issue an opinion on the consolidated financial statements. Next, we will be moving on to the specific issues in group audit. The issues are further expanded into 1. Setting the materiality level. 2. Issues on different accounting policies. 3. Language issues. 4. Non-conterminous year-end. 5. Letterbox companies. 6. Subsidiary audit exemption. First one is on how the materiality level is set. Materiality level differs based on the party conducting the audit. Group overall materiality is higher compared to component materiality level. Secondly, for the issue of different accounting policies, the auditors must ensure that the financial statements are consistent with following the local financial statements. There should be a reconciliation made. And in some cases, there is a need of adjusting centrally the statements to align the accounting policies. Group auditors are responsible to understand how group management deals with this issue through the perspective of accounting, and then designing an audit response that reflects this. Third, there may also arise the issue of language issues. In this case, where auditors are unable to speak the preferable language fluently, it is advised that a translator is engaged during the audit. 4. Non-conterminous year-end. Why does this issue arises? In general, groups will try to be aligned with the components year-end to make the consolidation process more easy. This is not always possible, where there are legal or regulatory restrictions, or where joint ventures have different year-ends, and it is impossible to be aligned with joint ventures. 5. Letterbox companies relate to companies, general and financial, which are from different jurisdictions to that of the company's jurisdiction. This is where only locally registered auditors are allowed to sign the audit reports. In order to resolve this, the group engagement partners are responsible to communicate with the people who are charged with governance. The engagement partners must also direct the work based on a group-wide controls together with the consolidation process. 6. Subsidiary audit exemption. There might be cases whereby exemptions may be available for the components. Therefore, the group audit is responsible to instruct the local auditors to carry out the audit by themselves according to the local requirements. The next performance is by principal auditor. Principal auditor is the one who responsible for reporting on financial statements, including financial information of components audited by another auditor. The term components refer to division, branch, or subsidiary whose financial information included in the financial statement audited by principal auditor. The term another auditor refer to auditor that responsible for reporting on financial statements but not the principal auditor. This is the consideration that principal auditor should take before accepting engagement. Materiality of the portion of financial statement. His knowledge on the business to be audited. The risk of material misstatement in financial statement. The extent of additional audit procedures. And the competence of other auditors. The rights of principal auditor under Section 174, 4, and 5, are: right to access to the accounting and other records of company in the subsidiary. Require oath. Our auditor of related company for information and explanations required for the audit. Require officer of parent company of foreign and local related company for information and explanations required for the audit. Principal auditor is responsible for every finding by other auditor, as further discussion will be made between principal auditor, other auditor and management. For every finding, the principal should properly documented. Financial statements of components. Significance of the finding to entity as a whole. Names of other auditors. Audit procedures performed and conclusions reached of each finding. ISA 600 stated two things related to group audit. First one is special considerations. The second one is using the work of other auditors. This ISA deals with special considerations that apply to group audits, in particular those that involve component auditors. The group engagement partner applies the requirements of ISA 220 regardless of whether the GROUP engagement team or a component auditor performs the work on the financial information of a component. This ISA assists the group engagement partner to meet the requirements of ISA 220 where component auditors perform work on the financial information of components. This ISA explains the matters that the group engagement team considers when determining the nature, timing and extent of its involvement in the risk assessment procedures and further audit procedures performed by the component auditors on the financial information of the components. For using the work of other auditors, when the principal use the work of other auditor, he should determine how the work will affect the audit. The principal need to discuss with the other auditor to make sure the work is synchronized. The principal should lead the planning, especially the timing of audit group, risk area and others. The other auditors also responsible and give a full cooperation to the principal auditor. We will now moving on to the next performance, related party transaction. Related party can be defined as a person who has a control over the entity, has a significant influence over the entity, and a member of key management personnel of the entity. What is key management personnel? It is a person who have the authority to control the activities of the entity. An entity is related to a reporting entity if any of the following conditions applies. 1. The entity and the reporting entity are members of the same group, which means that each parent, subsidiary, and fellow subsidiaries are related. 2. When one entity, an associate, a joint venture of other entity, or when one entity is associate and one entity is joint venture, or both entities are associate or joint ventures. So, how to identify related party? Let's take a look at this illustration. A. Berhad is the parent, a holding company. B. Berhad, C. Berhad, D. Berhad and F. Berhad are all related parties to A. Berhad. B and C. Berhad are subsidiaries while D. Berhad are associate of A. F. Berhad is the sub-subsidiary of A. As for related party transaction can be defined as a business deal, a transfer of services to related party prior to the dealing, and such transaction is required to be disclosed in financial statement by standard. These are the type of related party transaction that need disclosure. Purchase or sale of goods, property, and other assets. Rendering or receiving of services. Leases. Transfer of research and development. Transfer under license agreements. Transfer under finance arrangements. Provisions of guarantee or collateral. Settlement of liabilities on behalf of the entity or by an entity on behalf of another party. Standard also require the disclosure of provisions of doubtful debt related to the amount of outstanding balances and the expense recognized during the period in respect of bad and doubtful debt. Intra-group transactions shall not be disclosed in the consolidated financial statements because information presented in consolidated financial statements about parent and subsidiary as a single reporting entity. Let's proceed with another talent, goodwill on consolidation. Goodwill can be defined as intangible asset that exists from the acquisition of another company at a premium. For examples, patents and brands name. Goodwill in consolidation rises when the purchase is more than the fair value of net assets. It will appear in the consolidated statement of financial position as an intangible, non-current asset, at cost less impairment. Goodwill shall be tested for impairment annually or frequently when indications exists. It shall be recognized in the consolidated financial statement of financial position as non-current asset. Meanwhile, as for negative goodwill, or also known as bargain purchase, it exists when the purchase is less than the fair value of net assets. Therefore, the accounting treatment for bargain purchase is it shall be recognized in the consolidated statement of profit or loss as income. Moving on to the impairment of goodwill. Any impairment loss will be write-off in consolidated statement of profit or loss. There are two types of impairment of goodwill. First is impairment loss of partial goodwill. The accounting treatment is it shall be written off against parent's share of profits. Second type is impairment loss of full goodwill. The accounting treatment is it shall be written off against parent's income and non-controlling interest based on holding interest. Letter of support might be issued because of the subsidiary is not a going concern. The parent will send out the letter of support to the subsidiary with intention to support the subsidiary financially. The letter of support can be accepted as an evidence for events which may give rise to business risks, like from the financial perspective that may cause significant doubt about the going concern assumption. However, we need to consider the ability of the parent to help, whether the parent have enough resources. These are some pointers that need to be observed with regards to the letter of support. The wordings may not necessarily create a binding legal obligation. Letter merely indicates a general intention to provide support. The auditor should exercise his judgment if legal advice should be obtained in determining the adequacy and enforceability of the letter of support as audit evidence. The auditor should take into consideration the intention and ability of the provider of the support to comply with the terms. The letter of financial support should be dated the same date as the date of the auditor's report. The financial support should be for a period of 12 months from the date of the balance sheet. Audit report of the subsidiaries. If it is not material at the group level, the auditor does not need to modify the audit report. If it is material to the group, the auditor needs to do a modification in the audit report. If there is a disclaimer in the subsidiary, the statement of except for need to be included in the group audit report. Everyone, we are almost at the end of our event. Are you ready to watch what this little cutie girl got for us? But before that, let's look at the section 266 of Companies Act 2016, Power and Duties of Auditor. Every auditor of a company shall report to the members on the financial statements and on the company's accounting and other records relating to those financial statements. If it is a holding company for which consolidated financial statements are prepared, auditor shall also report to the members on the consolidated financial statements. In the case of a public company, the report is laid before the company at its annual general meeting. While for private company, the report shall be circulated to its members and laid before the company at a meeting of members. Auditor is not responsible in the preparation of financial statements as they are responsible to express an opinion on the financial statement. They has a duty to form an opinion whether financial statements are prepared in accordance with the Financial Reporting Standards of Malaysia and Companies Act 2016. Financial statements give a true and fair view of the financial position. Obtain reasonable assurance that the financial statements are free from material misstatements and the accounting records is properly kept in accordance with the provision of the Act. Auditor shall report any failure in respect of any matters. For the purpose of the audit, auditor has the right to access to require information on the accounting and other records from any officer of the company, at any annual general meeting and to speak any part of the business of the meeting that concerns him as auditor, to require any officer or auditor of the subsidiary to provide information on the consolidated accounts, to receive any notices relating to any general meeting. The auditor's report shall be attached on the consolidated financial statements. It shall be read before the company in general meeting and shall be open for inspection by any member at any reasonable time. If the auditor found that there has been a breach of any provisions of Companies Act 2016, or there is a serious offence involving fraud has been committed against the company controlled by public company, auditor shall directly report the matter in writing to the registrar.